Okay, everybody, welcome to Tom's Trading Essentials week number 3. This is a special week we're doing tonight, and this is called Credit Spread Overview, or what we call Credit Spread Mastery. With me tonight is Devon Pearsall. Devon, good evening.
Hey, good evening, Tom.
Great to have you on, and it is awesome here. We are going to be hearing and learning about an actual trading system tonight, and how we actually take one of our strategies, which is the credit spread, and turn it into a viable trading system, which is something that you do and you've been doing for several years now. So I call you the credit spread king. And I think people are going to find out why here in the next 90 or so minutes. Before I begin, if you could pop on that disclaimer slide. All right. And folks, you've seen the disclaimer. I do it in every single webinar that I present in. And just keep in mind here, you can read this from top to bottom. You can see it in the recording that will be going out shortly after this event is over. Basically, what it says is that stock and option trading has large potential rewards, but also large potential risk. You must be aware of these risks and willing to accept them in order to invest in the stock and option markets. The other thing I want to mention is that me, Devon, and everyone associated with Tom's Trading Room LLC, all right, that's our educational company. We are not your brokers. All right, we are your educators. We're here to teach you what it is we do. All right, you need a broker to trade with. You must meet certain requirements, and everything we're going to talk about tonight is in U.S. dollars unless noted otherwise. And that is it. Before I turn this over to you, Devon, so the last couple of weeks, we started off talking about calls and puts, and we talked about the need for a trading system or a trading strategy. And the strategy that I don't use is hope and think. And so what we talked about was directional trading strategies the last two sessions. We used
Okay.
we used RMD. We used OIH as a case study. We also used
Okay.
OIH last week with loophole trades and ISRG, and I've really kind of proven to everybody a couple of things, and that's number one is that we can set these up where you can take a very minimal risk if you're wrong, but also trading the particular trading strategies we used featuring the money calendar and also something called Darknet. We put those to the test. And last week we did a case study in Apple, which is between last week and now is up a little bit, all right, even with the pullback that we saw today. But this isn't much of a pullback here. And I think Devon's going to really kind of teach you, what it is he does and how he likes to take what he calls a 93% average probability trade. Only he does it
92, Tom. 92%.
excuse me, 92%. And your plan is to really kind of show these guys, exactly what it is that you do, and this isn't something that you're just kind of firing and forgetting. This is an entire viable trading strategy that you use day in and day out. So I'm going to turn it over to you, Dev. So take it
Okay.
away.
Yeah. Yeah. Hey, it sounds great. And first off, Tom, thank you very much for having me on. I absolutely love talking about a few things. One is fishing, and the other is trading credit spreads, and in particular, layered credit spreads. And as Tom mentioned, this is something that I've been working on, folks, really since, the later part of 2005. All right. So this is not something that I thought of, hey, this morning, what am I going to talk about this evening when Tom has me on? Or this is not something I talked or even thought about, last week or last month. This has been over 10 years in the making. And I really thought about, how can I take something so simple as a credit spread and turn it into something that can be a viable business, a trading system, if you want to call it that. So, folks, just a little bit about me. I've been involved in the markets for, almost 20 years. I used to manage a direct access trading firm. I managed a group of proprietary traders. I used to be involved in day trading. I've traded stocks, options, futures, commodities, currencies. I've traded just about everything that's out there. And over the years, when I first started in trading options and day trading, I used to work very, very hard. In other words, I used to watch the markets every minute of every day. And, something my father taught me years ago is he said, just in life in general, he said, son, he says, you need to learn how to stop working hard and start working smart. And I thought I was doing that with my trading because I was really in control of my financial future. But, I was really trading money at risk, as well as a lot of time in terms of research to have an output or have some sort of an income in the trading world. So, I really made it my quest. Okay, how do I truly work smart? And, that means how do I make a sustainable amount of money consistently? And how do I do that while still being able to go fishing? and in recent years, spending time with my family. In other words, how do I do this in the least amount of time possible? And I've got some really, really exciting things to show you here this evening. One of which is a case study that you and I are going to go out and find together. And Tom, I'm going to go out on a limb here, and I'm going to say that we can find a couple of 92% minimal probability credit spreads in less than 15 seconds. All right, 2 of them in less than 15 seconds. So I want everybody to hold me to that when we get there. But here's what we're going to do. First things first, we're going to talk about basic markets. I'm going to give my remaining market outlook for 2016. We're going to spend just a couple of minutes on credit spread basics. And Tom, if I can get you just on the standby there, after we show the markets, I'd like to ask a poll question, that first poll question that we have set up here in regards to what your knowledge of a credit spread is, or experience with credit spreads are. So just be on the standby for that, Tom. We're going to jump into layering. What the 2 keys of layering are. We're going to do an overview of money management, talk about how it really advanced the system since the market correction of 2008. If you want to call it that, right? That catastrophic oopsie daisy of 2008 October. In terms of how I've added insurance, used credit spreads to pay for insurance, so none of my essentially own money, but use credit spread profits to pay for insurance to make the system even safer. We're going to talk about that a little bit here this evening as well. Tom, I really wish the class tonight was approximately 15 hours because we have a lot of information I'd love to talk about. Then we're going to talk about what to expect in the upcoming March 30th Credit Spread Master Series workshop. I know that so many of you are already registered for this, and this is where we take basically what we're talking about here tonight to the next level. So first things first, let's jump into the markets. Today, the Dow is down 80 points. Like as Tom mentioned, just a little bit of a pullback, not much. The Russell, which we're going to talk about here this evening, was down 21 points. Let's take a look at, let's switch over to a chart of the Dow. And let's just click that button here. There we go. So I've got this already preloaded, just a basic chart here. It kind of shows where we were back at the beginning of the year, where we had basically a closing price of 17,425. January, kind of a tough month, right? We sold off down to a price of 15,450. We've had a major level of support, which we've hit twice. And we have had it pretty incredible here. The 50-day moving average, we've busted above the 200-day simple moving average. We have resistance that's holding out here to about 18,000 on the Dow. So I'd like to start all my classes here with my new groups in terms of, okay, where do I think the markets are going to go between now and the end of 2016? So based on what we see here on the screen, right, the markets are below a major level of resistance, above a major level of support. We're above 2 major moving averages, folks. I'll be honest with you. I have absolutely no idea what the markets are going to do between now and any time moving forward. Okay, now before everybody logs off, what I want to start to do is introduce you to an idea that we don't necessarily have to be able to predict the markets with a high degree of accuracy. In fact, we don't need to be able to, with some systems, we don't need to be able to predict the markets at all. And I'm going to show you that here this evening. In fact, as I mentioned to Tom or to everybody here that was on the call, since we got logged back in, that, the market that we're in right now could not be setting up any more perfectly for what we're going to start talking about here this evening. And what that really is not just layered credit spreads, but it's trading bullish and bearish at the exact same time in any market, in every market, not being concerned what the markets are doing and having a very high degree of what I call wrong factor, where the markets can go against us by a substantial amount. and we can still make a consistent profit. We'll talk about that, okay? So let's switch over here, back over to my slide. Tom, if I can get you to put that first poll question on the board. Before we get started here, folks, I want to find out what your experience level is with credit spreads. So, so how many of you have traded credit spreads before? What's your experience with credit spreads? So select one of the following. You've never heard of them. Does this involve, Tom put some of these answers together here for me, I'm reading it. So does this involve credit default swaps? Heard of them, never used them is what that should say. Know what credit spreads are, and I've traded them before. Okay, so select one of those three. Well, I guess four. But select one of the following answers there. Let's kind of see where you're at. This is just going to determine how much detail we go into the basic credit spreads and how I explain them to you as we go forward. And really what I want you to understand tonight more than anything is the concept in terms of probability, profitability, and how we can use this tool, really on one or two markets. We're going to talk about that here this evening as well. We don't need to go through looking at, 4,000 approximately total optionable stocks. We can build a system that we use only on one or two markets. So we'll start talking about that here this evening as well. But I want to kind of see where you're at. Tom, let me know when most of the folks have completed the poll. We're going to put the results on the board. All right, let's go through. Let me kind of take a look at this. So 8% of you have never heard of them before, which is all right. And I don't want anybody to be scared by the fact that you've never heard of them before. Everybody has to start somewhere. And for those of you that don't have any experience with them, or have heard of them but have never used them before, that's another 42%. So we have basically half and half. Half of you have traded them before. Half of you either know what they are, don't know what they are, but have never used them before, right? So those of you that don't have experience with them, don't be concerned with that. In fact, those are some of my best students because I can share with you a system or a set of rules, and for you it's a lot easier to follow because you don't have anything else to fall back on. So, folks, thank you for participating in that questionnaire there. Tom, let's go ahead, and I think you have to remove that off the screen, and we're back in business here. So, two different types of credit spreads. First off, we have bull put spreads, and on the screen, and I like to use my pen a lot, so let me go ahead and engage that. So with a bull put spread, this is or should be, I should say, a semi-bullish strategy. Now, in the industry, or in this industry, bull put spreads are typically taught as being a bullish strategy, and folks, that is just simply not correct, depending on how they are set up. Bear call spread, same thing. These are a semi-bearish strategy, not necessarily a bearish strategy. In other words, we can position a bull put spread and be wrong by a certain degree, by a certain amount, and still be profitable. We can position a bull put spread, have the markets move bearish by maybe 5 or 10%, and still be able to make the intended profit on the spread. I'm going to show you some examples of that here right now, actually. So let's go ahead and jump forward, take a look at a basic chart. This particular market is trading at a price of approximately 600, 590-ish, something like that. Trading credit spreads can be done on something like Starbucks that's trading, $55, $60 per share. Something like Amazon can be done on something like major market, like what we're doing here with the Russell. So with a bull put spread, let me change my pink color here, and we'll go over here to my black pin color. Our bull put spreads are all going to be positioned below the current market price. And our bear call spreads are all going to be positioned above the current market price. So for example, what we're going to do is we're going to construct a bull put spread with two different strike prices. Now I'm going to explain this in a couple of different ways. But essentially what we're going to do first off is find a strike price, maybe down here at 540. We'll talk about strike prices in a few minutes. But the first part of the construction of this is we're going to sell a put option. Now, some of you recognize selling a put option as being a fairly risky strategy, which it is. essentially what we're going to do is we're going to alleviate a good majority of that risk by turning right around and purchasing a put option. And this is going to create a spread. I'll give you an example on just a fictitious stock here in just a couple of minutes. Same thing with our bear call spreads. We're going to select the strike price, and we're going to sell a call option, and then we're going to turn right around and we're going to buy a call option. These call options, put options, are going to be positioned for the same month. For example, we might be using April, which is 22 days before options expiration. Some of the examples we're going to take a look at in the case study that we're going to find together, you and me, this evening, will be done with April expiration spreads. So we do not want to position these so that we have one April call that's sold and a May call that's purchased. That will not, I mean, it could be done, but it's going to defeat what we're trying to accomplish here this evening. These spreads can be moved up. These spreads can be moved down, or vice versa. These are what's called out-of-the-money credit spreads. And a bull put spread is a specific type of a credit spread. Bear call spread is a very specific type of a credit spread. Now, depending on where we position these are going to generate a credit, or what's also known as a maximum profit. When we position these spreads, for example, let me erase that arrow there. What we want to have happen is we want the market to stay above where we sold the put at, and that's with our bull put spreads. Our bear call spreads, we want the markets to stay below a certain level. So let's just say, for example, let's say that this particular spread pays a 10% return on investment. Okay, now return on what? Return on the amount of money that the broker is going to require that we hold for this particular trade. Okay, we'll talk more about that here in just a few minutes. So hypothetically speaking, let's say it pays a 10% return on investment. In order for us to get that 10% payment in, let's say, 22 days, the Russell has to stay above a price of approximately $540 per share, currently trading at a price of approximately $590. So even if, this is a bold strategy, right? So even if the Russell sells off approximately 50 points, this particular trader could still make a 10% return on investment. If the market stays sideways at this 590, we'd still make a 10% return on investment. If the market goes up to a price of a gazillion, right, we'd still make, in this example, this 10% return on investment. So the market can really move 2.5 directions, and we can still make a maximum profit on this strategy. Now, first off, that's why I really like this idea. If the market goes below 540, some of you are probably thinking that might be a little more experienced. Yeah, that's where you get hosed, right? We'll talk about that. That's why I started layering years ago, and that's why I added insurance in 2008. Now, actually, not like Geico, or Allstate Insurance, but we're going to use another form of an option, which I believe you talked about in last week, called a debit spread. We're going to use that to actually protect these particular spreads that we set up. Let's go through another example. Let me switch over to my tablet computer here, and let's just say that we have a stock that's at a price of $47 per share, okay? And we have a idea that the stock is going to stay in a fairly narrow trading range between now and April the 15th, so the next 22 days. So maybe a couple of, 2-3 point trading range. Maybe it'll sell off a little bit, maybe it'll go up, maybe it'll stay sideways, who knows. So let's say that we want to position a bull put spread. So what we would do in this example is we could sell a $45 put option. And let's just hypothetically say that that particular put option is selling at $4. So we would receive that $4 in terms as a credit. Now, what we're going to do to protect ourselves is, and turn this into a credit spread, is we are going to buy, for example, a $40 put option, and that's going to cost $3. I want you to think of this $3 or this purchase option here really as an insurance policy for the credit spread. The difference between 4 and 3, between the sold and the purchased option, is going to become the credit, which in this example is $1. The credit, and when you sell a credit spread, it's not like that $1 automatically appears in your account the next day. That is a myth. This $1 is a maximum profit that you can make on this trading opportunity if the market stays above $45 between now and options expiration. Now, in terms of looking at risk, and I'm going to go through this rather quickly here this evening. I did work out with Tom. Those of you that are registered for my workshop, I am going to do a little bonus options basics where we're going to take approximately 90 minutes. We're going to do this next week, next Tuesday, so put that on your calendar, where we go through and I explain all this in greater detail, as well as exactly how to place these trades with with one of your popular online brokers. And really all the online brokers work about the same, but I'm going to walk you all the way through how to open a spread, how to close a spread, and configure spreads and all that other good stuff. But the basic mechanics of that next Tuesday. So in terms of looking at what the broker is going to require that we hold on this trade, the basic way of configuring that math is take the difference in strike prices, which is $5, and subtract the credit or maximum profit, and that is going to get a hold price that the broker is going to require that you hold of $4. Now that $4 is also known as the maximum risk on this particular trade. So we're holding 4 to make 1. We are risking 4 to make 1. Now some of you might ask, why in the heck would you risk $4 to make $1? That seems like an inverted reward to risk ratio, and it is. And the answer is, and Tom kind of answered this earlier today, is because of the probability of 92%. And this is technically our maximum risk, right? If we do absolutely nothing and we don't take a proactive approach with these particular trading opportunities. Think about this. If you were to go out and buy Starbucks at $60 per share, I don't know exactly where it closed at today, but somewhere, near that price line. Our maximum risk, right, is $60 on that trade. Technically, it's $60 on the trade. If the market started going into a catastrophic movement and you're holding on to Starbucks, would you hold on to that and lose the entire $60? No, hopefully not, right? You're part of, Tom's group, and you're going to have some sort of a stop loss in place or a protective put option in place, and you might be willing to risk maybe $3, $4, $5 of that 60. It's going to be the same thing with our credit spreads, but this is what our broker's going to hold. Just like if you go buy a stock, they're going to hold the value or the cost of that actual shares of stock, or you go buy an option, they're going to hold the value or the cost of that option as well. So we're holding 4 to make 1. If we were to do some simple math and put 4 into 1, that's a 25% return on investment. So this trader can make, in this hypothetical example, a 25% return on investment on this trade, providing this stock stays above $45 between now and April's expiration. Okay, 22 days in this example. We could do the same thing with a bear call spread. Let's just say hypothetically that we sell a $50 call option at a price of $4. We'll use the same numbers. We could buy a $55 call option at a cost of $3. That gives us $1 credit, and the numbers are the exact same, right? We'd be risking 4 to make $1. We'd have a 25% return on investment. Now, if you put both of these together, what a broker essentially calls this is an iron condor. That is a fancy name for having a bear call spread and a bull put spread open at the exact same time on the same market for the same expiration. Now this is kind of cool because now essentially what we want the markets to do is stay between this trading range of 45 and 50. Now, when I look at a credit spread, let me switch to a different sheet of paper here when I'm explaining these to the new folks, and we'll get into some more detailed information here for those of you that do have experience with credit spreads in just a couple of minutes, so bear with me. I want to make sure that we're all on the same page here. First, when I look at credit spreads, I like to think of them essentially or represent them as a bar, okay? So for example, we have this bar, and this represents a credit spread. Let's say that the top of this bar is the price of 45, essentially exactly what we just did with building this hypothetical credit spread, right? So that price of $45, is, you know what, let me do this. Let me switch back over here, and let me do that on this sheet here. We'll start talking about probability and profitability, and let me just catch up here. Oops, back up, 47. and we have this bar. All right, so 45. So, and the end of this bar is April the 15th, which is 22 days before options expiration. 23 on some markets. We'll talk more about that a little bit later. So that spread that we fill, let's say just hypothetically speaking, right, it pays a 25% return on investment. Again, return on the amount of money that is being held. And let's say that that particular trade, just again, I'm making up numbers right now. Let's say that it has a 75% probability, we'll just put prob for short, 75% probability of actually occurring, meaning that we have a 75% probability of this market staying above this price of 45 between now and April's expiration. Now, probability can be measured several different ways. We can use options Greeks, such as the options delta, to determine probability. We can look at fancy probability calculators like Tom has on his trading tools, which are awesome. It does it for us in a fraction of the time. In fact, I've helped Tom design a high probability credit finder. We call it Credit Trapper, that uses those calculators to determine that probability. So you can use a fancy calculator. You can use options delta. Those of you that are registered for my workshop next week, we're going to use both. I'm going to show you both of those techniques to determine probability. But we can move this credit spread. We can move this bar. You know, for example, we could set this bar up at a lower price, right? We could set this bar up at a price of maybe $40. So that might look like selling the $40 option, maybe buying the 35 or buying the 37.50. So essentially moving that sold option down to a lower level or further out of the money. Now, there's a relationship with the return on investment and the probability as we start building these trades that are safer. So for example, if we do create this credit spread down here at a price of 40, right? Now what we want the markets to do is, they're at 47, we want the markets to now stay above $40, not 45, but we want them to stay above $40 between now and April's expiration. We're giving ourselves a little bit more room to be wrong and still make a profit, right? Now, that just sounds good when I say it, right? We're giving ourselves more room to be wrong and still make a profit. Now, how many of you have ever traded options before and been right and lost money? See, now this is taking options and really turning them so they're in our favor here, using time value to our full benefit. This is really cool. So let's just say hypothetically that now the return on investment is going to drop because our probability is going to increase. So let's just say that this one has an 8% return on investment, 8% return on the amount of money that's being held. And let's say that our probability jumps up to a value of 92. Now, I notice as I'm writing these numbers down that if we take 92 and 8, it equals 100, and 75 and 25 equals 100. That's a coincidence, okay? There is no direct correlation between probability and return on investment to equal 100%. So just as a side note, we will take a look at some real numbers here on a real market in just a couple of minutes. But just want to use this as an example because, you know, the art of trading credit spreads really comes down to coming up with an area where we're happy with the return on investments, all right, and we're happy with the probability on the trade. So let's take a look at some real numbers. I want to show you what I call what a goosebump trade is, and what we're going to do is we're going to start by and we're going to end by taking a look at the Russell. Now, we're not going to end on this particular slide, but every example that we're going to look at from this point moving forward, folks, is going to be on the Russell. The ticker symbol is RUT. You're going to want to write this down. Now, the reason for the Russell, and I can prove what I'm going to say, is the Russell has, with credit spreads, in terms of turning this into a system, and we can use credit spreads on individual stocks as well, but in terms of turning this into a system where we can trade it day in and day out, as Tom mentioned earlier here, we want to trade a market that gives us consistently the highest probability trades that pay the most amount of money. Now, I want to talk about that idea for a minute because some of you might be trading. Some of you might have no trading experience. Some of you might have been trading for 10+ years. Okay, we have a variety of different folks that are on the call here this evening. So think about this. Those of you that do have a little bit of trading experience or even investing experience, why do you buy something? Well, the answer could be really simple, right? It's you buy something to make money, right? And from an investment standpoint, correct? Or trading standpoint, I mean, that's just another word. It's a shorter term investment, right? So when you invest in something, whether it be a stock, whether it be a classic car, a piece of art, a rental property, a piece of real estate, whatever the case is, when you buy something as an investment, you buy it to make money. Is that correct? So, which I know it is, right? So when you buy something to make money, think about this. Well, now let's break that down and say, well, if we could start calculating probabilities, wouldn't it make sense to invest or trade where we have the highest probability of making the most amount of money in the shortest period of time? And the answer to that is the Russell is the answer to that in terms of layered credit spreads. Now, I wish I had a couple hours to go into this here this evening. I don't. Those of you that are signed up, and I know many of you on this call already are, for my 5-week workshop starting next Wednesday, March the 30th. That's the first thing we're going to do is we're going to start talking about what's called ATR, or average trading range. I'm going to show you exactly how to compare the Russell to the S&P, to the gold market, to whatever market that you want to. Maybe even individual stocks like Apple or Amazon or whatever you want. And I'm going to show you so you have without a doubt that the Russell is the highest probability market that pays the most amount of money. I want to show you that for a couple of reasons. Number one, I don't want there to be any doubt as you're learning how to layer and you're getting experience with me layering the Russell week in and week out. But the more important reason is, in 2-3 years, will the Russell be the highest probability market? The answer is, I don't have a clue. So I want you to be armed with the tools necessary to go out there and compare markets and truly compare probabilities in return on investments, truly compare apples to apples, so that if the Russell does fall out of favor in a year, 2, or 5, the Russell's been my favorite market really since about 2006, late 2006, early 2007. But if it falls out of favor down the road, I want you to know how to go out there and find the highest probability market. So let's take a look at some data on the Russell from October 5th. Now, this is 45 days before options expiration. All right? Now, by the way, this particular chart, this is like 3 or 4 years old. I pulled this example out of an old presentation. I'm like, I'm going to show them this example first. Now, why would I show you an example that's 3 or maybe 4 years old? It's an old one. I'm going to show you an example that this one here is 4 years old. I'm going to show you another one that's approximately a year old. Folks, I'm going to show you one that is a week old, and then we're going to go out and find one from today's close. And the reason I'm walking you through this progression here on the Russell is, as I mentioned, I've traded it for a long time, but I want you to see the consistency in the quality of these trades and these case studies that we're seeing over the years. Because, it's easy for an instructor to, stand up and say, hey, here's a good looking trade. You'll never see it again, maybe for another 3 or 4 years on this market, but hey, this was a good looking trade. Well, this was a good looking trade on the Russell, and I will assure you that these types of trades I just got goosebumps thinking about this, they occur virtually every trading day of the year. Okay, so let's take a look at this. So the market is, I need to change my pin color here. The market is currently at a price of approximately $590. So the first spread that we're going to take a look at uses the strike prices of 530, 540. So if we were to break this down in terms of bought and sold options, we're selling the $540 put option. So since this is below the current price, this is a bull put spread. All the examples we're going to look at on this slide are bull put spreads. We're selling the 540, buying the 530. A trader could make a return on investment of 21%. Now, the market's at 590. Again, this is 540. So that is a 50-point, let's call it wrong factor, where the Russell could trade against us 50 points. Let's say we think the markets are going to go sideways. We think the markets are going to go up. There's been an uptrend for the last 4 or 5 months. So if we're wrong, right, by 50 points, we could still make a 21% return on investment. And by the way, this particular trade has a measured. This is not something I've made up. None of these numbers are stuff I made up. These are actual numbers. This one has a probability of 78%. Okay, now there's no doubt about it. That's a good looking trade, but that's not what I call a goosebump trade. Now let's define what a goosebump trade is. All right, you may not may not have heard of this before. Well, at least Devon's goosebump trade is when I look at a credit spread and I say, why in the heck would somebody pay me to take that small amount of risk? It seems too good to be true. All right. So let's take a look at another one, a little safer trade. Now this spread is positioned further out of the money using strike prices at 500, 510. Again, these are both put options. So a trader would sell the $510 put option, buy 500, and this would create an 11% return on investment for 45 days. This particular spread has a measured probability of 87%. So our return on investment is dropping, right? Our probability is significantly increasing. Now, again, the art of this credit spread is to find a balance between these two. I'll tell you right now that the average credit spread trader looks at the return on investment only and says, hey, I can make 21% if I'm right. They don't think about what they're going to lose if they're wrong or how often they're going to be wrong in terms of looking at probability. Okay? They don't annualize numbers and say, wow, I could position something really safe that I really don't have to worry about a whole heck of a lot and still clean up, right? And do very, very well. So anyway, let's take a look at this spread here. So let me do some math here. So that's what, 80 points out of the money. So we could position the spread. If the Russell goes up to a gazillion, we would make an 11% return on investment. If the Russell stays sideways at 590, we would make an 11% return on investment. If we're wrong on market direction and the Russell goes down 80 points, we could still make an 11% return on investment. That's a good spread, but it's not the goosebump trade. All right, let me show you the goosebump trade. All right, let's just get to it. This is what I love to do, and this is what I built a layering system out of, is these types of high probability spreads. Look at this. Using the strike prices of 470, 480, so we're selling that $480 put option, buying the $470 put option, generates a 5% return on investment. And by the way, this spread now has a 93% probability. The Russell's at a price of 590, right? We could be wrong by 110 points on this particular spread, and we could still make a 5% return on investment. Now I need to do some math here. Hold on just one second. I want to let me run just a quick number. So we can make, say, a 5% return on investment. We are 110 points out of the money, so I'm going to take 110 divided by 590, which is the current price as of this particular slide creation. That is 18%. So let me reword what I just said. We could open up this spread. The Russell could trade against us. This is a bull put spread, a bullish strategy. And the Russell could trade against us. We could be wrong by 18.6% and still make a 5% return on investment for 45 days. Now I've got goosebumps. See, I look at a spread like that, a trade like that, and say, why on earth would somebody give me a 5% return on investment? That seems too good to be true. Right? By the way, how many of you like that? How many of you like the idea of being wrong by a substantial amount and still being able to generate some money? That's the benefit of trading a credit spread. Let's look at some other examples. Let's take a look at a more current one. This is from last year. Again, we're going to work up to today. Okay, I want to show you. When I teach my classes, folks, I don't just show you something and expect you to take my word for it. Now, I'm an honest guy, but when I'm a student, I like my instructors, my mentors, to prove it to me and say, hey, I want to know without a doubt. So that's what I'm doing right now. I'm showing you some different case studies, and we're learning and having fun along the way. But here's an example on the Russell where the current market is trading at a price of 1,170. Now, again, this is from last year, January 2015. Markets traded at 1170. So we're going to start mixing in a bull put spread and a bear call spread. We're going to start this layering process here really over the next couple of slides. So we're using strike prices down here at a price of 1,030, 1,020 with the bull put spread. Now that generated a total return of 5.8%. We have the exact credit that was received. So per 10 contracts, that would be $50. That equates out to 5.8%. If we're trading one contract, divide that by 10, trading 100 contracts, multiply that. We can do the math to, come up with different dollar amounts, but that's why I like to look at the return on investment, because the dollar amounts will, they will vary, right, based upon our contract sizing. 92% probability trade. So we sold the 1,030, purchased the 1,020 using February's expiration. Want the markets to stay above 1,030 on this bull put spread. Now, at the same time, we positioned a bear call spread up here at the top strike price of 1,270, 1,280. So we sold the 1,270 call, and we've purchased $1,280 call. Now, again, for those of you that are registered for my 5-week workshop, I am going to do, and I just committed to Tom just a few days ago, I'm going to do a bonus mechanics class where we're going to go through a number of these different examples. I'm going to show you exactly how to place these spreads, so they won't place orders on these spreads, instruct the spreads, work through all the numbers. We're going to spend 90 minutes-ish, maybe 2 hours, where we have more time to go through and work on just simply the mechanics of these spreads before we get started with building this layering system and really, really kick this off to the next level. So here we are priced at 1,270, 1,280. This generates a 5.4% return on investment. We want the market to stay below this price at 1,270. Now, this is where things really get real with trading and starting the layering system on the Russell. Because if we take a look at this trading range, right? This trading range here is, it's 240 points. Now, if we take that 240 divided by 1,170, that equals approximately 20% of what the Russell's trading is. Now think about this. The market can fluctuate, right, up to 20% up and down, right? A combined 20% down, whatever the exact percentage is there, and maybe 12 and up 8. The markets can fluctuate 20%, and this particular trader, right, if they were to position this, could still make a combined 5.8 plus 5.4, which equals 11.2. And what I'm going to show you next Tuesday when we start working on the mechanics is with some brokers, depending on how you set these trades up, right? We can set these up so it's truly set up as an iron condor, and the broker uses what they call double margining, and the 11.2 actually is going to turn into a little bit better. It's going to turn into 11.9. Now, I know that sounds like fuzzy math, right? But it's the short answer of why that is because we are essentially guaranteed to win on one of these spreads. So the broker's only going to require that we hold enough money for one of the two, right? It's impossible to lose on both of these if we leave them open all the way to options expiration. So I'm going to talk about that in much greater detail next Tuesday. But let's just call this approximately a 12% return on investment. The markets can fluctuate 20 over the next 31 days, and we can still make a 12% return on investment. So at the start of this presentation, I gave you my market outlook. And I said, folks, I'll be honest with you, I don't have a clue of what the markets are going to do moving forward the next week, the next month, the next year. And I said, but we don't necessarily need to know that information. So now, I don't have a clue of which direction the markets are going to move moving forward. But as long as the markets stay inside this ginormous trading range, I can be fat and happy, right? Now, what do you think about that idea of waking up in the morning and seeing the Dow down 250 or 300 points and saying, yeah, that's not a big deal because I can be wrong by a substantial amount and still make money, right? How many of you now that are trading wake up early in the morning, you watch CNBC, and you're like, oh, the markets are down 250 or 300 points. I wonder how my bullish strategies are doing. Or, oh, darn, the markets are up 200 or 300 points. I wonder how my bearish strategies are doing. And that's the first thing you do is go check. Right? Right now I'm on vacation. I'm in beautiful Orcas Island, just northwest of Seattle with my family. And in fact, I'm sitting here in the rented a little office space at the little local Woodmere real estate group, and just a fantastic group of people. And they let me use their office here, so I come in here and spend some time with you this evening. And I've not been watching the markets over the last few mornings or afternoons, not until the markets close. Because do I need to with this strategy? Now, don't get me wrong, looking at market direction for my directionally based trading opportunities is something that I do. This is my favorite strategy. This is what I do most of the time, with the majority of my portfolio. So I don't need to be concerned with exactly what the markets are doing. I'm learning how to truly work smart, not hard. Let's take a look at another example. And Tom, if you can just have that next whole question at the ready, would be greatly appreciated here. I'm going to go through and show them another one before we dive into that. But folks, this is one that was taken from last Wednesday, March the 15th. All right, so we're getting a little bit more current. So I want you to see the consistency with these spreads. Now, the Russell was trading at a price like 1,066 ish. I think it's where we were at, 1,070, something like that. So at that particular time, a trader could position the spread down here using the strike prices of 970, 960. Now this is for April's expiration. Now it's 30 days to options expiration. We're going to talk about exactly the best times to position these credit spreads on the Russell in terms of layering. In fact, we're going to use this case study to essentially start a layer here tonight that we're going to build upon next week. This is going to be really, really cool. I'm going to be showing you before too long how to layer multiple month spreads, April and May, for example. So 960, 970, we could sell that $970 put option by the 960. That creates a return on investment of 5.2%. That one had a 93% probability. Now, we could create this bear call spread at 1150, 1160, and that created a 6% approximately return on investment. If we look at this trading range, this trading range is 180 points, and this one has approximately a 17%. Now let's call this flux factor. All right, the markets can fluctuate approximately 17% between 970 and 1150, and we can make a combined rate of return that's going to be near 12%. It's actually going to be a little bit over 12%. Now I know that if you take the 6 and 5.2, that equals 11.2. But when we learn how to turn these into a true iron condor and place these orders correctly, depending on who our broker is, we'll talk more about that next Tuesday, that return's actually going to jump up to about 12.6%, right? Let's just call it 12. We can have this flex factor of 17%, and we could still make a 12% return on investment for 30 days. Annualize that. So when we looked and compared those other case studies to like a 21% return on investment versus an 11% return on investment, and we kind of worked our way down to 5, it's like, why don't we focus on the 11 or 21% trades? The answer is because we don't have to, right? We can look at these trades, they give us goosebumps, position these spreads. So when we have days like today where the Russell was down, 21 points today, it's a pretty large move on the Russell. It makes no difference. In fact, you know what? The market's actually sold off, and our probability on these trades went up. In fact, what we'll do before the night is over is I will give you an update on where these case studies are that we did last Wednesday. I'm going to show you where they're at currently today and how we can use these 2 case studies to add a layer tonight. I'm going to show you with an actual example, and what I'd like to do is take this example from last Wednesday plus the current one from tonight, and I'd like to carry that into the workshop for those of you that are joining me. And I know we have a few extra seats on that open too. I know not a lot. I think maybe 10 or so. But I like to carry these case studies so we can A, talk from the past, and B, build upon them in the future. So anyway, so we can be wrong by essentially 17%, right, and still make a combined 12% return on investment. So if one of you were to ask me now, right, oh, hey, Devon, hey, where do you think the markets are going to go moving forward? The answer is, I don't know. And you know what? I don't know if anybody ever watches CNBC, but at 11 o'clock, they have one analyst that thinks the market's going up, and at 11:05, they have another analyst that thinks the market's going down. I mean, reality is, folks, and if you want to look at statistics and probabilities, reality is that when you, a trader, whether you be retail or professional, you're wrong 50% of the time. Those are statistics. Now, let's take lemons, turn them into lemonade, right? I'm not trying to diss anybody on the call. I'm just saying those are statistics that are in the market, that when we predict market direction, there's too many other factors. You could be the best chartist in the world, but if some sort of a terrorist event occurs, or major earnings come out that are unexpected to be better or worse, or whatever the case may be, that can move the market up control. That's what I'm saying. So instead of choosing, instead of trading mostly directionally and having those types of influences, right, now I can trade more non-directionally, bullish and bearish, and have these types of worldly market events occur, or just simply being wrong, and take all the stress away from trading and not have to worry about these little 2, 3, 400 point moves in the Dow. Now, can we lose money on these trades? Absolutely. We're going to talk about that. We're going to talk about how do we hedge and protect ourselves, because statistically, about every 6 weeks, we're going to be wrong on a trade with the layering system. Tom, do you have that second poll question loaded up? And I'm very curious to see where you're at before we move forward here with really taking these high probability trades and turning them into a layering system. So folks, I want to see, I know some of you have seen, some of you already registered and seen an overview of what I do with layered credit spreads before, but really kind of geared more towards the folks that have not seen this before. What are your initial thoughts on these types of high probability opportunities? So please select one of the following. Love making money even though I'm wrong on market direction. That would be, that would be me. That's what I love. 2, prefer directionally based trading, where I have to be right on choosing the right market direction, the right stock direction, the right option, and so on. Okay, now there's no right or wrong answer. I just want to see kind of where you're at in terms of what you're thinking. Or answer number 3, don't know a thing about probability, teach me please, which we're going to get into more here this evening. So anyway, Tom, when you get the results there, go ahead and broadcast those so I can kind of see where we're at. And then we're going to go into what the problem with most credit spread trading systems is. Now, we've talked about turning this into a system, and, really, this is just such a fantastic opportunity, because I mentioned that I do trade directionally as well. And the key to picking trading systems is picking systems that really match up and meet your trading personality or investment personality. And, I do trade directionally based a little bit. This is where my love is. This is where my passion is. As I mentioned, there's no right or wrong answer. I just want to kind of see. I want to see where you're at. So let's take a look at the results here. 70% of you, love the idea of making money even though you're wrong on market direction. 25% of you, don't know a thing about essentially probability. So teach me some more. And then 5% say prefer directionally based trading, where I have to be right. Now, the benefit of directionally based trading, right, is that you have the opportunity to make a little bit more money. It's a little bit more work. You have the opportunity to make a little bit more money. You might cycle through trades a little bit quicker, and so on and so forth. Again, no right or wrong answer. I appreciate, thank you, Tom. You can go ahead and take that down. I appreciate everybody participating in that poll questionnaire there. So let's get into the problem with most credit spread systems, because some of you created credit spreads before. So let's talk about that. And let me switch over to my black pen. So let's say we have a market, we build a credit spread system. For this example, let's just say that we're building a basic bull put spread. So we build this basic bull put spread, and let's say that we start out with 5 contracts. We want the markets to stay above whatever level that sold strike price is. So we get good at it. And then we take that 5 contracts and we change the 5 contracts to 10 contracts. We continue to trade this for a few months. We get good at it. We might go up to 11, 12, 13 contracts. We might work our way up to 15 contracts. We get good at that. And then all of a sudden, guess what happens? The markets reverse. The markets go down. We're wrong. And when we're wrong, we lose when we have the most amount of contracts. Now, that's what happened to me. I mean, I literally was profitable for 11 months in a row when I first started trading credit spreads. Some of you can relate to this, right? And then you have that 12-month, one losing trade where you lose. Basically, you get back all of your profits for the previous 11 months. Now, that doesn't make sense. That's what, as I've traveled over the years, and I've been teaching classes on and off since, really, gosh darn it, 98-ish, 1998, 1999, somewhere in there. Different levels of, stocks and options and so on. But, as I've traveled around with Tom and Jay and talked to students that have traded credit spreads before and then kind of given up on it, this is where they fall into, because this is what's being taught in the industry. And in my opinion, it's absolutely wrong. And if you're trading this way, at some point you're going to probably give it up because it's not working. It doesn't make sense. I mean, think about that. Now, when I first started trading credit spreads, let me switch over to my tablet computer. I read this book called Options as a Strategic Investment. It cost, or the price on the book was like $30. The actual cost was tens of thousands of dollars. You don't need to read it. In fact, please don't. Don't write that book down. There's no money management in it. But I like the idea. Tell me the mechanics of, here's the market. I can open up a bull put spread and a bear call spread, and the markets can stay in this range. I could be wrong, and I can make money, right? Kind of like what I'm showing you so far. But what happens when we're wrong and the markets go against us? What happens then? Well, I remember having a streak of winning trades, and I can't remember which market I was trading. I think I was trading the OEX at the time. And I like the idea and the consistency of when I was right. There's just one thing I didn't like. When I was wrong, I lost many months' worth of profitable trades. So I remember riding my motorcycle one day, and it's kind of funny how thoughts come to me. And I was riding my motorcycle on a little backcountry road by my house where I lived at the time. And this idea popped in my mind, and I stopped. And in my truck, I don't have a motorcycle now, but in my boats, I keep a sheet of paper and a pencil. Same thing in my truck. So if something pops in my mind, I can write it down. And same thing with my motorcycle back in those days. So I pulled over, and I had this thought. I got, gosh darn it. Let's just say I was trading 20 contracts, right? I don't remember exactly what the contract size was, but let's just say it was 20 contracts. So what would have happened if I would have changed up this 20 contracts? Because the markets went against me, and ultimately it was wrong, and I lost some money on it. So I got thinking, okay, if instead of opening up this spread maybe 40 days before options expiration, if I would have opened it up instead of with 20 contracts, if I would have opened it up with 10 contracts, yet maybe 10 days earlier opened up a different spread at 10 contracts, when I was wrong, I would have still lost, but I would have only lost on half the amount of contracts. And essentially, that was the start. That was back in 2005, the start of this concept called layering, right? Which is now a full-blown proven trading system for the last 10 years. But at the time, it was a concept. So I got thinking. In fact, I turned around and I went back to the house, and I started doing some back testing. If I would have, let's say, averaged in over different levels and spread or layered the risk of these credit spreads at different areas on the chart and split up my contracts, when I'm wrong, I would have lost half. And then I had this other idea. Well, gosh darn it, if I'm going to do that, what would have happened if I would have done something like this? Instead of doing maybe 10 contracts apiece, what if I would have had 5? And then more frequently, what if I would have averaged another 5 and another 5 and another 5? Am I going to be wrong occasionally? Absolutely. But when I'm wrong, I might only lose on 5 contracts, maybe 10, but I'm not going to necessarily lose. It's going to take a huge move to lose on the entire 20 contracts. So what I found was that by doing this, when I'm wrong, I might lose on 5 contracts, but have 15 profitable to help offset the losses on the 5. And then if I start doing the same thing with the bear call spreads, right? If I do the same thing with the bear call spreads, then I have more profits to help offset a substantially smaller loss. That's the start of the layering system. It was not, I didn't sit around one day thinking, gosh darn it, what can I create to make sound good to entertain people on stage with? This came out of a necessity. I love trading credit spreads. I truly, I love the idea. I love the concept. I love knowing what my profit is before I enter. I love knowing what my maximum risk is. And more than anything, I love being able to be wrong by a certain amount and still make a profit. But now out of necessity, I've come up with a way so that when I'm wrong, now my losses are substantially smaller. And that set off this 10-year trading system that I call layering. So what is layering? Layering is adding multiple credit spreads over different time frames to A, bring in cash flow, and B, most importantly, help reduce the risk of our total credit spread systems, okay, or total open credit spreads. I mean, that's really the purpose of this, is to help reduce the risk. I mean, we have to bring in cash flow as well. So we're going to be positioning more spreads, and I can, Tom, I'm sure we're getting some questions right now in terms of, okay, aren't we paying more money in commission? Let's hit that. Let's address that one first. The answer is yes. We are paying more money in commission. But gosh darn it, I mean, what are commissions now? We can do an online trade somewhere between $5 and $15 for most of us, right? I mean, that's the competitive brokerage fee right now is $5 to $15 per spread. So we're going to pay more money in commissions? Yeah. Instead of paying let's just average commissions to 10, instead of paying a $10 ticket for one trade, we might pay $40 to have 4 at smaller contract sizes. So is it worth an extra $30 to significantly reduce our risk when we're wrong? The math shows, heck yeah, it is. Now, back in the old days, our commissions used to be substantially larger than what they are now. So commissions really are what I call non-factor. I mean, yes, we pay them, but they're incredibly small. All right. So now this works typically best on index markets. This does not work well on individual stocks. Let me go ahead and switch my slides here. So, this works really well. We've already talked about the Russell. Ticker symbol is RUT. This also works fairly well, and I have a different system for the S&P, or ticker symbol is SPX. But my favorite market, the one that we're going to talk about during the 5-week workshop, is going to be specifically the Russell. And I mentioned this as well. I mean, we can be wrong on market direction, but folks, we're going to be trading multiple spreads, right? I featured one last week, the one I showed you recently. We're going to talk about that again before tonight's over, and I'm going to show you how we could layer the same market on the Russell for the same options expiration here today. We're going to go out, roll up our sleeves. We're going to do this together in just a few minutes. So instead of going through a list of 4,000 optional stocks, it's going to be, hey, what's the Russell doing today, right? What's our $940 strike price spread looking at, or what's our $970 probability currently at? What's our $1,150 probability currently at? We'll be looking at credit spreads as strike prices, not individual markets. Now, the reason it doesn't work really well on individual stocks is the volume and open interest is not there to position continuous layers as the markets are moving and fluctuating. Most of the index markets, like the Russell and the S&P, they have a fair amount of volatility in terms of charts, in terms of options pricing, meaning the options are a little bit more expensive, which is great for an options, primarily seller's world. Yet the volatility on the chart is usually less. If you look at the percent fluctuation of the Russell versus some other stocks like Chipotle Mexican Grill or Amazon or Google or some of those more expensive stocks we might sell credit spreads on, we're going to see a smaller fluctuation in percentage price, higher volatility on the actual options pricing, which nets us a higher return on investment. So in other words, we have a higher probability market and, and a higher pain market. So in a perfect world, folks, here's what we're going to accomplish. We're going to open up spreads somewhere between 20 and 45 days before options expiration. Now, these are I refer to these as recipes. Now, I want to be real clear. We don't necessarily position a spread at 20 days or 30 days or 45 days. These just tend to be the average times of when these spreads get open. And really, we can open up spreads any time between 20 and 45 days. Today, we're going to look at 22 days before options expiration. But the reason we don't want to look at greater than 45 days before options expiration or less than 20 is a couple of reasons. Number one, volume and open interest. Greater than 45 days, it's not there. It might take longer to get into a spread. Okay, not only that, but if we're wrong and we have to make what's called an adjustment, which we'll talk about here briefly in a few minutes, we're not going to have the volume and open interest to close that particular spread. In other words, we're going to lose more than what's expected. So we don't want to trade in that illiquid market. We want a very, very liquid market. When we start looking at spreads less than 20 days before options expiration, then we look at these probability models not necessarily being as accurate as what they would be, let's say, 21, 22, 30, 44, 45 days before options expiration. And the reason is the closer we get to options expiration, the less time value that we have in those options, and that kind of throws off the probability models just a little bit with how they're computed, and that can equate into greater losses. Now, we'll talk about that. In fact, we'll take a look at specific examples somewhere around week 3 of the 5-week workshop in terms of why these are the best times. And I've tested a lot of different times. This is the best time frame to be inside. So in a perfect world, which, you know what, coincidentally, I've already peeked at the markets here this evening. We're going to see this tonight. We're going to see it this week, really. The markets don't always move in this fashion, but I want to show you how this would work. And then I'll switch over to my tablet computer and show you what this would really look like in a trending world as well. So 45 days-ish before options expiration, right, we're going to look at opening up this bull put spread and bear call spread. These are 92% probability spreads that are going to pay a minimum of a 5% return on investment. We're going to position those spreads. In a perfect world, we're going to let a little time go by, a week or so, and then we're going to position another bull put and bear call spread. Because we have less time value, our spreads are going to get a little bit closer to the market, but they're going to remain 92% probability trades that pay a 5% return on investment. In a continuing perfect world, we're going to continue to do the exact same thing all the way to 20 days before options expiration. So let's take this over to a tablet computer because, as I mentioned, and as many of you know, right, the world is very seldom perfect. So if we have a trending market, let's just say we have a market that's trending up, and one of the things with the trading credit spreads is we're never going to predict market direction. And, you know, I've already really mentioned the reason why, but I'll mention it again. It's because statistically we're wrong 50% of the time when we predict market direction. So why even try with this system? Okay, now, if we're trading a directionally based trade where our reward to risk ratio is not inverted and our probability is lower, then it makes more sense to put a prediction on the markets with a stop loss and contract sizing and things such as that. But with a credit spread where we have an inverted reward to risk ratio, we want to remain bullish and bearish 100% of the time. So in this case here, let's say that we open up a bull put spread. I'm just going to represent it with two horizontal lines and a vertical line that connects the two. Right, top line is that sold strike price, and the bottom one is the purchase strike price. And then we're going to position a spread, a bear call spread above the markets. Let's say the markets continue to go up. We would continue to layer as the markets go higher. If the markets continue to go higher, we would continue to layer if they get too high, we might have to make what's called an adjustment on the spread in danger. Essentially, what we're going to do is we're going to open spreads. In fact, I'm going to write this one down. You may want to write this down as well. We'll cover this in substantially great detail. We're going to experience it firsthand over the next 5 weeks. But we're going to open up these spreads when they have a minimum, right? Minimum of a 92% probability. What we're going to do is I'm going to show you how to close these or make an adjustment on these when the probability, if the probability drops down to 80%. Let's just put out, we are out of that spread. Now think about this. Okay? I mean, many directionally based traders would be ecstatic with an 80% trade. But now as high probability layered credit spread traders, we're not. We want to trade the absolute best of the best. And if it falls out of that category, and this is really the best of the best of the best of the best of the best, and if it falls out of that category, we're not going to stick around. And as Tom mentioned earlier tonight, right? We're not going to stick around and hope, wish, and pray. We're going to be out of these case studies. We're going to exercise our insurance. Talk about that in a few minutes. And we're going to continue to open up new high probability trades, all on the exact same market, the Russell. Some of you will take that to the next level and work into the S&P as well. But I assure you folks, you know, I have many students that have been trading the Russell for years and only trade the Russell with their credit spreads. I mean, they can keep you busy for many years. All right.
Hey, Dev.
Yes.
Real quick, we're getting, Jay and I are answering questions on here that, and some of them keep kind of repeating themselves. And one of them is, more and more people are wanting to know how to register for your series, which starts next week. We're going to be just letting everyone know, we're going to be putting a special link on the chat window here within just a few minutes, so that you'll be able to sign up. It is a premium series we do. There are a small limited amount of spots, and I'll explain why that is when we get to that. But I just wanted to kind of jump in there, and we got people say that really want to sign up for this thing, and I'm just letting them know. Hang on, we're going to have a link for you shortly.
Okay, yeah, that sounds good, Tom. I know that we're almost full on that workshop there, but I'll look forward to taking on a few new students here as well. So I really can't wait for next Wednesday where we build upon. Anyway, let me go ahead and jump back forward here. Let's talk about this word consistency. Okay, consistency is, it's really the name of the game. This is the secret to making any trading system successful, whether it be layered credit spreads or whether it be trading stock split announcements or earnings announcements or trading off of money calendar or anything, right? Whether it be Tom's systems or Christina's or Mike Wade's, myself, consistency is the name of the game. Consistent profits, consistent small losses, consistent profits that are greater than those losses. And that's, once you gain that consistency, then you can start to increase your contracts with having some sort of a high probability in terms of expectations, right, for what to experience in the next few months. So I'm going to show you some consistent results. This is from the workshop, the 5-week workshop that I taught for Tom last year. This is the last time that I taught this class. Back in the olden days, let's call them, 2005, 2006. I used to travel, and I live in Portland, Oregon. I used to travel about 50 to 55 times a year out of the airport. I know that because I kept all my bag tags and room cards, and it was really way too much. And then I had a family, and that really slowed down. Wanted to slow it down. I just got burnt out on traveling, but I still love to teach, and I love teaching credit spreads. And this is really all I do is teach this once a year for 5 weeks, and then I spend the rest of the year with my family and fishing and camping and family fishing and camping together. Many times right now as I mentioned earlier, we're in beautiful Orcas Island and with the family here and just having an absolutely wonderful time with a couple of friends of ours, and my sister and her husband as well came up. So we're just, anyway, having a great time What we're going to do with the case study that I've already showed you from last week, we're going to build upon that tonight. We're going to build upon that over the course of the next 5 weeks, and I have another bonus for you as well that's going to really turn that 5-week workshop into, and I'm just going to say it now, into a 9-ish week workshop. It might be 8.5, it might be 9.5, somewhere in there. We'll take a look at that here shortly. But anyway, every single case study, every single layer, we're going to document, we're going to put together, we're going to analyze, and break it apart at the end of the series, good, bad, or ugly. This is what we did last year, and I want you to look at the results. Now, this is based per 10 contracts. So we have profits of $500, $450, so on and so forth. You can read those. The average profit is $505. So when I look at a system, I look at an average profit. How far off of this is that from the average? Well, we have a high profit of 600, and you say, well, the larger the number, the better. The answer is not necessarily with all trading systems or trading systems. So what I mean by that is if we have a really large profit somewhere, that might mean that we took a substantial amount of risk, because there generally is a correlation between risk and reward. Doesn't necessarily mean that we're going to be right next time. So I like to have my profits very, very consistent. We have that here. We have insurance, which I'll talk about in a few minutes, that cost some of those profits. But it gave us a total profit of $2,540 for 5 weeks. Now, is that good? Is that bad? Well, that works out to be an 8.6% return on investment for 5 weeks. Now, that is of the total trading capital, right? Each individual spread might have had a 5%, or that combined iron condor of 11.5 or 12%. But looking at the combined account performance that we were using is 8.6%. So that's really not too bad for 5 weeks of stress-free layering. And I want to talk about that just a little bit more, the stress-free, because what we're not doing is we're not managing our spreads during the day. In fact, I want you to write that down. With the layered credit spreads, we do not want to manage our spreads intraday. Use your time intraday to manage other trading systems, your directionally based trading systems. In fact, it will be better to manage them historically based upon end-of-day data, making decisions when emotionally we're not as invested as we are during the markets, where we can take a few extra minutes, go through our scenarios, make sure that we perform our adjustments correctly or find new high probability trades correctly. And then simply place with our GTC orders, good till cancel orders, we can place orders to trigger the next day, or we could place them even early the following day. My goal for you, if you choose to become a layered credit spread trader, is to be able to layer and manage your spreads in a total of approximately 1 hour per week. Now, not 1 hour per day, but 1 hour per week. And it really doesn't take a whole heck of a lot of time. And you're going to get to see just an insight of that here in just a couple of minutes. In fact, we're going to do that right now. But anyway, we take 8.6% for 5 weeks. If we were to annualize that, that's not too bad. Right? So it goes back to, why do we want these high probability trades? Well, because if we do these high probability trades and we learn how to layer them, and we even spend a little bit of money on insurance, okay, through the use of debit spreads, and you start playing around with some of these numbers, why would you want to compromise that, where you can be wrong by a substantial amount of money and still, be wrong by a substantial market move and still make a decent amount of money, not have to worry about the markets every single stinking day? So the two keys to trading credit spreads are this. Number one is proper order placements. Okay. Number two is solid money management. You say, well, what in the heck does that mean, Devon? Proper order placement. Proper order placement, simply put, is goosebump trades, right? High probability, 92% probability trades that pay a minimum of a 5% return on investment. You may want to write that down. 92% probability trades that pay a 5% return on investment. All right, so how do we find those trades? You know what, let's go do this right now. How do you find these trades? There's a couple of different ways. And what I'm going to do, I'm just going to switch over to a basic option chain. This is one on one of the brokers that I use called Thinkorswim. Some of you, through TD Ameritrade might have this broker. You might have another brokerage, that's fine as well. But what I want to do is I want to show you just the basic options here for 22 days out, April's expiration. We have approximately 150 different strike prices for the month of April. So how many of you start looking at these strike prices and going, holy criminy, where in the heck do I start? Well, we can use the options delta to convert into probability. Okay, I will teach you how to do that somewhere around week 2 of the 5-week workshop. It's going to take, once you get good at it, it's going to take about 10 or 15 minutes to do this. Let's just call it the good old-fashioned way. All right. The other thing that we can do is I want to go over and I want to show you one of the coolest things I've ever seen in the credit spread world. And Tom, I wish I could take the credit for this, but I really can't. Tom has some of the best, or one of the best software builders that I've ever seen. And Tom and I had this conversation about a year and a half ago, and Tom says, hey, Devon, what would it take for you to work with my developer and take what's in your brain with layered credit spreads and these high probability trades and to convert this into a button on my website? Go to Tom's tools. And I said, Tom, I don't think it can be done. I mean, it really should be done by hand. There's too much stuff there. And he says, work with them. And so I worked with them, and well, it took about 3 months. But you know what? We got this button right here called the Credit Trapper. I designed it. Tom and his developer have built it. You know, they get a majority of the credit for this. I just gave them direction on what to do with the many hundreds and hundreds of hours, probably into the thousands of back testing that I've done. And we've put this together on one little push the button, and essentially it's done. Now, I told you at the beginning of the class that I'm going to have you timing in terms of how long it takes to find a couple of high probability trades. Why don't we go ahead and start that timer right about now? All we're going to do is click on search. All right, so what are we, 2 seconds, 3 seconds into it, we're done. That's it. We have 2 case studies here, and both of these trades have a minimum of a 92% probability. Both of these pay a minimum of a 5% return on investment. Now, this scanner is not designed to come up with 50 different potential opportunities. Some days it comes up with 1. Some days, it's rare, comes up with none. Some days it comes up with maybe 3. This is the best of 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 the best, period. Right here, return on investment, 5.4%, or let's call it 5.5%. This one's 6.61%. We have our put spread, full put spread. We have our bear call spread. And if we go into these, it'll even tell us. If we go into these spreads individually here, I'm just going to do this quickly. It's going to even tell us exactly which option is bought and which option is sold, and exactly what the bought and sold price is. And it gives us more details on that particular spread. Let me go ahead and close out of that window. We're going to spend a lot more time on this down the road. But what I want to do is I want to write down these spreads. In fact, let me switch over to my tablet computer, and let me grab my notes from that case study that we looked at a little bit earlier, right? So earlier tonight, we looked at a case study from last week, okay? That, the Russell was at a price, let me get rid of that squiggly line. Last week, the Russell was at a price of approximately 1,066. Now, I ran the scanner. We could have done this by hand as well. These are April expiration options. This came up with strike prices of 970, 960, and that paid a 50-cent credit or maximum profit, which is about a 5% return on investment. For our call side, we had 1160, 1150, and that was open at 62 cents. That was about a 6% return on investment. So a couple of things I want to do here quickly is, A, let's take a look at these case studies today. Now, I'm not going to go into the option chain. It's just going to take a little bit too much time, and we're not going to, build a closing price. I've already done this. On our bonus class next Tuesday, I will show you exactly how to close a spread. In fact, what we're going to do is I'm going to use Thinkorswim as the simulated, to play simulated trades for you. I'm going to show you exactly how to build spreads well, right off of Tom's tools and to build those case studies, how to close these case studies. And also, I'm going to show you how to use a basic option chain to look at delta, convert that to probability. So you can make the decision on the road. Do you want to do this the old-fashioned way? And there's nothing wrong with it. It takes 10 or 15 minutes. It's not that bad. You want to use Tom's tools and have this done in 10 or 15 seconds, or tonight's case, 5 seconds, right? Somewhere in there. So anyway, that's part of that mechanics class or primer class where we're just simply going to look at, for those of you that don't have experience with credit spreads, just simply looking at, okay, how do we actually facilitate this? It's one thing to learn about it. It's the other thing to actually put, the rubber to the road and actually, place that spread. Well, tonight, this spread is worth 30 cents, okay? In fact, let me use my green pen. This spread is worth 30 cents tonight, which is good. We sold it for 50. It's worth 30. That's where we can buy it back at. We're not going to buy it back at 30 cents. I will show you way down the road, somewhere around week 3, of how to buy these back at a substantial discount and close them early. But we'll get to that down the road. So right now, essentially, folks, we're at 40% of this maximum profit. That's good. That's I love that. Now, this 1150, 1160 that I showed you from last week was open at 62 cents. The current price on this is 15 cents. So we run the math on that. We're approximately 75% of the way, right, to that 62-cent profit or maximum credit. Now think about this. The Russell's gone from 1,066 up to about 1,100-ish, down to 1,075 where we closed here today. The markets have gone up. The markets have gone down, right? The markets have moved bullish and bearish. The markets have moved essentially against both of these spreads at some point. We are trading bullish and bearish, aren't we? And both of these trades are making money, even though the markets are moving both directions. Gosh darn it, I love that. And that just gave me goosebumps just thinking about it. And I've been doing this for a long time. It takes a lot to get me excited. I look at these spreads and think, my God, goodness, why doesn't everybody want to do this? Well, not everybody's on the call here this evening, so that's why. But anyway, so this is where we started. And the question I want to talk about for a couple minutes here is it possible to now bring in another set of trades, another layer to what we've already started? So I showed you the simple way to find these spreads, right? So here's a couple of these trades. Let's go write them down, okay? You don't need to write them down quite yet. Let's go write them down on this sheet of paper, and I'm going to use my green pen just to mark the difference between where we started last week, where we are here today. So using the strike prices now, 980, 990 on the put side, again for April's expiration. This is a 92% probability trade. This spread pays, I'm just going to use return on investment, pays a 5.4% return on investment. We can now position on the call side at 1130, 1140. So both spreads are closer to the current price. This one coincidentally also pays a 62-cent credit. Well, I said I wasn't going to tell you what the credit was, but I just did. But this one pays coincidentally the same credit, which is 6.6% return on investment. So essentially what we're doing, same market, Russell, same month, April, is we're adding the second layer, and now what we want the markets to do is stay between, and we're doing this with smaller contracts than what we would originally have done if we were just doing one spread. So we want the markets to stay in this 140-point trading range, and now the markets can be wrong by, or the markets can move 13%. We can have this 13% flux, right, fluctuation factor, and we can still make now a combined 5%, 5.4, 6.6, and 6% return on investments. But what if we're wrong, right? What if the markets go against us? Let's just say they go down a little bit. We lose on one of these spreads. We lose some money on this 5.4%. We lose all that. And let's say we even lose 2 or 3 or 4 or 5 or 10% on that spread. But now we have a 5% profit, a 6% profit, another 6% profit. So do you see the importance of creating these layers. So if we're wrong on one of these trades, what if the market's going lower? We lose on both of them. Let's say we lose 10% on each spread, so we're down now a total of 20% of what we're holding for these trades. Let's say, just hypothetically speaking, we're down 20%. Well, now we've got a 6.6%, a 6.6% profit. So we have approximately 13% of profits offset, maybe 20% of losses. So now our losses is only, somewhere around that 7-ish% loss instead of 20. So by layering, spending just a few extra dollars on commissions, right, we're accomplishing some major tasks when we're wrong on market direction. So folks, I want you to write down this slide here because this is what we're going to do. This is my intention, is as we move into next Wednesday, what I want to do is I want to talk about all of these case studies from last week to current. We're going to rebuild them. We're going to go back. We're going to refine them. I'm going to show you exactly what I did, exactly how to manage these spreads. And then as we get into week number 2, we're going to be exactly 45 days before options expiration. And I want to show you how to use these April spreads with the upcoming May spreads and start managing now 2 different months and layering with 2 different months, a front month and a second month, and show you how that process works. And that's really the benefit for those of you that have not registered for the 5-week workshop, is we're going to do this every single week. We're going to go out and find these case studies. We're going to spend a lot more time on it. We're going to do it the old-fashioned way. We're going to do it with Tom's tools. We're going to do it both ways. And I do have some rules that are black and white in terms of being able to or not being able to overlap strike prices, exactly when we open them, when we close them, and so on and so forth. But this is the template that we're going to start with in terms of managing spreads and finding trades moving forward. I can't wait. Let's go back over here to our slides and talk about money management just for a little bit, because we're going to use some different techniques. We're going to look at delta adjustments, and I already mentioned to you, looking at adjustments and adjusting when we have a probability that drops below 80%. And Tom, if you can just ready, don't put it up yet, but just ready that third poll question would be awesome. Now, back in 2008, had my layering system, and it worked fairly well. But I thought, how do we improve upon the system? How do we make it better? And that's where I started to add in insurance. And this is the evolution of a true trading system, and not something that was just created last month. This is something that's been in the works for over 10 years. In 2008 was a major game changer, same in 2010 during the flash crash, of how do we further protect our spreads, because it gave you some illustrations with current market data on what could happen if we're wrong, right? But what happens if we're really wrong and the market's going to a major catastrophic movement, either up or down? How do we offset and how do we hedge those losses, even more so? So, if I can show you just the concept of what we're going to get into right around week 3 is this. Essentially what we're going to do is we're going to, let me divide this into 2 sections here. Right side is going to be credit spreads, and the left side, I'm going to call this insurance / debit spread. Okay, I just put debit there for short. I know my writing's a little squiggly there, writing on this vertical screen. A little challenging here this evening. But anyway, so what we're going to do is open up a bull put spread and a bear call spread, kind of like what that first spread was I showed you last week. Okay. Now we're going to take the credit or the money that we are expecting to make off of those, the maximum profits, and we are going to reinvest the profit over here on our spreads. Initially, that profit's going to be invested into some debit spreads, which we're going to call insurance policies. We're going to use our credit spreads to pay for debit spreads. Now, the beautiful thing is the markets go down, our credit spread's going to lose, our debit spreads should make money. We're not going to do this every time. There's a strategic time when we open up these debit spreads. In fact, it's going to be at the beginning of the month cycle, okay, for those options. So when 1 month expires, that's when we're going to open them for the next month. I've done an enormous amount of back testing on which deltas and probabilities we look at. We're going to go through that system in a great amount of detail in terms of how to find those. In fact, I want to show you this just again real quickly. Is over on Tom's site, this little button right here, we have things called the adjuster, which is going to give us a horizontal line representation with exactly which strike prices and where we adjust. This also has right here, find insurance. It doesn't say find debit spreads, it says find insurance. It'll show us in seconds exactly which debit spreads and how many contracts based upon what our credit is we purchase. I mean, how fast is that? Now, I mean, I can't tell you how much work has gone in to making this as cool as what this is, but I will show you the good old-fashioned way to do this as well and let you make the decision on what you want to do, but also kind of let the cat out of the bag on one of the other bonuses that Tom and I are going to do, and that is make sure that everybody has this tool for my workshop. So everybody's going to get to use this. All right, so let's go back over here to the tablet computer. Then essentially what we're going to do, folks, is, you know, when we have opportunities, exactly like we do here tonight, to open up new layers, we're going to open up those layers without additional insurance. That's where we make our money. Next week, we do the same thing. The week after, the same thing. The week after, the same thing. Essentially on April the 15th, when these options expire, then we'll purchase new insurance. So we might have 3 or 4 layers per month where we have essentially one of those layers is going to pay for some insurance. You might ask, well, Devon, why in the heck do you want to pay for insurance? You know, doesn't that offset some of the profits? And the answer is it does, right? It does take away from some of those profits. But, you know, we look at those results from last February, or excuse me, last March, April, when I did the workshop for Tom, 5-week workshop for Tom. Even though it cost us $1,000 from the $3,540 profits, it still yielded about an 8.6% return on investment. One of the things that we're going to look at, and I don't have the exact numbers with me since I'm on vacation here, I've got them back in my office at the house, is back in Portland. We had an adjustment a couple of 2.5 weeks ago, and it was an awesome adjustment. We had insurance that made approximately $200 more than our credit spread lost. Now, think about that. This doesn't happen all the time, by the way, but I'm going to show you that adjustment. We're going to take a look at a lot of adjustments so you get really good at mastering when the markets are wrong, when the markets go against you. And so we were wrong in market direction, and we still made money. Again, it doesn't happen all the time, but that's why we buy the insurance, and why not? One of our credit spreads is paying for it anyway. So this is something that you're going to become an absolute master on. This has really been a game changer in terms of trading credit spreads. Tom, do you have that poll question number 3?